think generally new stablecoins will benefit existing stablecoins because they need to be paired with something on chain. Like, how is that not glaringly obvious to these folks? And I will there be 1,000 stablecoins that end up working? Probably not. Maybe like there's 10, but like each of those things will have either a different client base, a different geographic focus, a different yield profile, a different backing standard. Like there is room for more stablecoins.
Hey everyone, quick shout out to today's sponsor, Namada. Namada is currently entering phase 3 of their mainnet rollout, so make sure you check it out by following the link in today's show notes. We'll talk more about Namada later today, but for now, let's get started. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another Bell Curve. You got Michael's 1 and 2 fans. Unfortunately, we're just virtual this time as opposed to our glorious in-person live. We got a couple of those recently. It's been fun.
Those have been nice. The last couple months, 2 in-person pods. I also we'll see, but I doubt that we've got 104,000 live streamers, whereas we did from DAS.
That's
pretty good.
Tons of people listening to this podcast.
that definitely hit some records.
Yeah, we had. I think when the big man came on, it was we got over 370 or something like that concurrent, which is pretty good. Yeah, but it was actually weird. We were joking. We were running about 15 minutes behind, and Jack O'Halloran, Jack from Scale, so everyone was kind of waiting for Trump, and then everyone was like, "Who is this guy, Jack, that's talking about Scale?" So it's very funny. But yeah, I'm curious. Like, what did you guys? I mean, I did a whole recap episode already with Jason on just like takeaways from the conference. But yeah, what did you guys? I mean, obviously, institutional corner of the world. Definitely a good amount of excitement. I don't know. Any takeaways or thoughts from your guys' standpoint?
I mean, I think one narrative is we've been saying for years now that the institutions are coming. I think the new narrative is the institutions are already here.
They're bold.
They're super excited.
They're bold up. Yeah.
Yeah. I mean, look, the Stable Act or the Genius Act for stablecoins is going to be seminal. There's going to be positive movements on other policy fronts as well. That just is going to clear a path for every major financial institution in the world to start to incorporate or integrate into DeFi. And that is a huge thing. It's not going to happen overnight. And we are an industry that has the worst patience of any industry I've ever seen. And people will expect it will happen immediately, just like we expected that the SBR announcement was going to be a massive TWAP that the U.S. government puts on. People have crazy expectations, but I think if you zoom out and you kind of like see what's going on, it's never been more exciting. Markets don't represent that. And so maybe that's another narrative of just like, I've been describing it as the tale of 2 cities. You've got on one end, markets feel like they're in the gutter. And honestly, a lot of that I don't think has to do with crypto specifically, or even within crypto, it's specifically meme coins. But once you actually pull back the layers and see what's going on underneath, some of the most important stuff is happening. So DAS, for me at least, was furthering of all of that perspective. Being able to hear people actually talk about it. I think it was Fidelity or BlackRock being like, yeah, we're going to tokenize assets. We're going to put them on Ethereum. And talking about, major banks in the US starting their own stablecoins. All of this stuff is, you would dream of this in 2021. And now it's actually coming to fruition. So very, very exciting. Markets don't represent the excitement.
So let me get your guys' take on this, because I've heard on a bunch of other podcasts, people ask this question is, okay, stable coins are here. There's going to be a bunch of RWAs on chain, but what do I do with that? Right. I don't really know how to get exposure to that idea. And if you don't have access to private venture deals, I sympathize with that view. What do you think about Robbie from BlackRock was speaking at DAS about how stablecoins coming on chain could be a bet on the L1 token, like something like Ethereum. So I kind of am of two minds about this. And in one instance, I could see something like USDT or USDC competing with ETH as like the money, like competing for the money use case on chain. But the other is if you end up generating a whole bunch of fees, and if people are holding, stables, and you do marginally more trades on the DEX, and that generates fees also. There's kind of like a fee argument and a moneyness argument. And, I'm curious how you guys think about when all these stables and RWAs exist on Ethereum. Like, is ETH a good play on those assets being issued on chain, or how do you view that whole interaction?
I would say yes. And maybe even just to take a step back, like, stable coins are a subset of RWAs in my mind, at least. And so Apollo launched their private credit ETF, I think early March. What do you think the inflows to that product are?
I can't actually articulate what the value prop is of why Apollo is issuing their.
But like, private credit's super hot. Like it's like the biggest narrative in traditional finance right now. What do you think the inflows are? Can't look.
Dude.
Don't cheat. All right, I'll answer it. $5 million from Apollo, which manages like $100 billion.
Right.
And so like people were saying like, why is like the BUIDL, tokenization Grand Prix thing so newsy? Like it's like BlackRock has $2 billion in its treasury product on chain. And like, Eric Balchunas was tweeting about the same with James Seifert.
Vance, can you just describe what the Grand Prix is?
Yeah. So the Grand Prix is Sky allocating $1 billion of their treasury into these various products to get, A, some diversity out of just like the USDC that they have, but B, a little bit higher margin in terms of like you're going to get 450 basis points versus 390 from Circle. And so like, it obviously jacks up their profitability, does a bunch of different things, but like this is the first big wave of tokenization. And right now between Athena and Sky, that's like 60 or 70% of all of the assets in BUIDL. And so like, that's like a huge win for them in the context of like people are launching private credit ETFs and getting like low single digit millions of inflows when you're like an Apollo. And so it represents this entirely new vector of growth for them. And I think what people are realizing is like the people who are going to make RWAs and tokenization real are the handful of DAOs on chain today that have a shit ton of capital to allocate. Most of those are stablecoins. And so like basically just talking about Sky and, Athena as well, kind of leading this tokenization wave. And I think that's massively bullish, and it's going to happen on ETH. And, I know Athena has their Converge chain. Sky, frankly, has like more of an Ethereum centric / L2 centric approach to it. But like liquidity begets liquidity. And like if you tokenize CLOs and put them on some random chain with no money on it, it's like you might as well have not tokenized it at all. And so I do think kind of there is this, the thesis kind of espoused by Kyle Samani at Multicoin, which is like this global state machine. In some ways it makes sense, in some ways it doesn't. The ways it doesn't make sense is like, why do stablecoins need to be on the chain with all the meme coins? It's like that one doesn't make as much sense, but like the CLOs should be on the chain with the stablecoin so that they can market make between each other, so that they can create the looping environment that's important for that to manifest. And I think it's super bullish ETH. I think it's super bullish Sky and Athena. And I also think like whoever the TradFi recipient of these assets is going to have a pretty huge business.
Okay, could you guys explain this to me? One thing I don't have really clear thinking on is I'm trying to get a sense of right now the way that collateral management happens for these especially centralized issuers is off-chain. All right, so USDC has a portfolio of off-chain treasuries, and you assume that Circle just does a good job of managing that risk. But one thing that I have a less clear intuition on is I saw a guy from Athena tweet that 95% of the incremental demand for BUIDL over the last 3 weeks came from USDE. I haven't verified that, but that's interesting if that's true. And I'm just wondering, is there an advantage for a stablecoin issuer at all of having that collateral tokenized and existing on chain as opposed to just being off chain with some custodian like BNY Mellon or Anchorage or whoever?
Well, I think if you're even putting anything on chain, it's still going to be custodianed in some
right.
BNY Mellon. Like there's still going to be that. What you still have to have is basically the analog to digital connection, where right. and they're all digital, but the analogy is basically, how do you make sure that there's an audit trail, that the T-bills are actually in the account that they say they are, that they're earning the yield that they say they are. You got to be able to connect that. Oracle Solutions help with this. Audit committees within these DAOs help with this. Being able to put it on chain is an important element when it comes to things like looping, or being able to use it as collateral within DeFi for these DAOs. If you were to say, hey, we're going to take the DAO's treasury and just like send it all to JP Morgan and go buy a bunch of T-bills with it, that's a less, I would say, crypto native approach than being able to say, we're going to take these assets, we're going to transfer them to USDC, put it into USD, we're going to buy the T-bills, then we're going to tokenize the T-bill representation on chain, put it into whatever the DAO ecosystem is, and this token represents the account that holds all the T-bills, that's earning all the yield, and we can verify it, we can audit it, monthly statements get put on chain, et cetera, et cetera. That's the type of ecosystem that I think we're referencing, where you have a digital representation on chain of what those off-chain assets are. You can have all different types of assets, and maybe these are NFTs of bespoke private credit deals or even real estate transactions. Like, you could represent anything on chain, but it still has to exist on chain. It's controlled within the DAO treasury. It holds, a connection to that off-chain asset, but then you also get the yield that flows through it as well. And I think that's, kind of the world that we are seeing play out, especially in the Sky ecosystem. They've been doing this for the last couple of years with their T-bill product. And I can't remember the name of it. Vance, you maybe remember the third party that was kind of facilitating all of it.
Block Tower, Andromeda. It's like
Andromeda.
RWA, but yeah, it's Block Tower.
Block Tower was kind of the operator of it, and Andromeda was the kind of the firm that was doing it. So all of this stuff already exists, but there is sort of like a looping element that you get when you put things on chain.
Cool. Yeah, that's what I was curious about. This episode is brought to you by Namada. Namada is the shielded asset hub rewarding you for protecting the multi-chain. Shield your data across any asset and any chain and get shielding rewards for helping strengthen data protection for everyone. To learn more, follow the link in the description below. This episode is brought to you by Marinade. Marinade is a high-performance staking delegation platform that brings both liquidity and security to the Solana network by connecting SOL holders with the best staking rates on Solana. Follow the link in today's show notes to learn more. Okay, speaking of, I want to talk about just venture capital, but before, since we're already talking about stablecoins, so there's actually a big week for new announcements of stablecoins. So there are basically 4 announcements here that are somewhat interesting. There's one, USD1, which is a new stablecoin that comes from World Liberty Fi, which is, I think, on Ethereum and Binance Smart Chain. Interesting. And then there is a joint new Avet, which is the stablecoin of Custodia, which is Caitlin Long's bank out in Wyoming, and Vantage Bank. And I get, maybe this is a little bit wonky, but I find it interesting. It's just a tokenized demand deposit, right? So it's not collateralized with anything. It's just literally a dollar deposit at a bank on chain, which is pretty cool, I think.
I saw. Oh, go ahead. Sorry.
We issued it on Ethereum too.
Yep.
And it's on Ethereum too. Yeah.
Ethereum. So respect.
State of Wyoming is talked about issuing their own stablecoin, also I believe on Ethereum. And then Fidelity is announced that they're going to launch a stablecoin. So tons of it's sort of what we've been talking about the last couple of weeks. I feel like in this world of new issuers, who's going to play in that game and whatever. And yeah, you're starting to see a lot of new issuers very quickly, very different types of issuers as well. So
it's great. I think there's a subset of VCs that are tweeting things like, we don't need another stablecoin, or it's like, there's no need to be gatekeeping things or being nervous about your portfolio. Like, if your portfolio is good, like, it will do fine. But I think generally new stablecoins will benefit existing stablecoins because they need to be paired with something on chain. Like, how is that not glaringly obvious to these folks? And, will there be 1,000 stablecoins that end up working? Probably not. Maybe like there's 10, but like each of those things will have either a different client base, a different geographic focus, a different yield profile, a different backing standard. Like, there is room for more stablecoins. Do I think anyone will displace the big 3? Probably not. But, I don't think we should be like gatekeeping this opportunity.
I did see a funny tweet though that was like, you walk up to the convenience store and they're like, sorry, sir, we're accepting JPM USD and PY USD. And actually, we've got a 5% off for any Amex USD. It's like,
great. Look, would you spend?
No, that's not going to be how it works. That's absolutely not how it works.
Would you spend Amex USD versus something else if you got some sort of benefit from it? 100%.
If we get to that state, we have lost.
I don't think that's right. I think that's hyperbolic.
No, no average consumer is going to care about what type of USD they're using at all. That is like, if we have gotten there, like the product experience is completely messed up.
Wait, but couldn't you solve that with some sort of, couldn't you abstract that all away? And
exactly. And this is the point. You abstract it, like as soon as you move JPUSD out of JP Morgan's walled garden, it becomes, I don't know, USDC or USDT or USDS. Like in DeFi, you get to choose which one you want. But I think there will be layers of abstraction, just in the same way that when I hold dollars at a Wells Fargo account and transfer it to a JP Morgan account, there aren't actually any dollars that go between those two banks. It is just like a debit and a credit in two corresponding accounts. Like that's how transactions work. Like we will figure out Nostro and Vostro for stablecoins. But right now, I think in the way that it seems like things are trending, you've got a war of all the major fintechs or the war of the major financial institutions being like, oh, my USD is going to be the most important, which I think is good for right now, but it won't last. And if we get to a consumer experience where you're having to choose which form of US dollar you're using to pay with, we're in trouble.
Well, Michael, what do you think about what I was just thinking as you were describing that is credit cards do some version of this, right? Where they're trying to incentivize their user base and merchants to accept their card, right? Like you do kind of have something like that. There's at least an analog, and it wouldn't like one, I had never really thought about this before until I'm just talking this through live, but one advantage for banks here, right? If your entire world of deposits, of potential deposits only have existed domestically thus far, now you can actually have an entirely new international world of depositors. And it might actually make sense to subsidize those depositors, right? In the beginning, it's just customer acquisition cost, right? Which is you could either try to pair up with merchants to get discounts for anyone using your stablecoin, or you could, and this is in the Haggerty Act, which is apparently payment stablecoins are not going to be allowed to offer yield to their users. I don't know if you guys saw this and have thoughts on that, but I agree. From the perspective of that's a huge pain in the ass from the user experience. I agree. But maybe there's something, you could even imagine a yield product, which just aggregates, like you have some stable balance in your wallet. You go to a merchant that's offering a deal and they just swap in and out or something like that.
I'm sure someone will abstract this away, but keep in mind, Visa, MasterCard, Amex are payment rails. They're not banks. They are data networks. And if you had to not only choose which card you were going to use at the point of sale, but if you also then had to choose which bank account it was coming from and then which type of dollar it was coming from, that's the poor experience that I'm referring to.
Okay, you're absolutely right about that. Yep.
I want to use my Visa card here and get the 1.1% back rewards, whatever. But like now I have to choose between 7 different stable coins that are attached to my Visa account. Like, no, that's not going to work.
I agree.
So that's more of what I'm referencing. There may be some interesting consumer payments experiences. And look, I worked on payments for like 5 years. I think the payments ecosystem is extremely efficient, extremely entrenched, and it's not going anywhere unless there's an act of Congress that basically breaks up the oligopoly of the payment networks. It's not going to move. And yeah, I generally think it's going to be really, really hard to do point of sale payments with stablecoins unless it's something like Visa, who integrates USDC or another asset and then uses stablecoins on the back end, which I think there was some rumor or some report that apparently WorldCoin is working with them on some crypto wallet to integrate USDC. We'll see. But there is kind of a question as to like, what do consumer payments look like? I generally don't. I think if we take like the 10,000 foot perspective on stablecoins, you basically think about what are the different use cases of stablecoins. Consumer payments, they don't exist right now. That's not something that I expect to be able to walk up, to the local convenience store, swipe my card, and have it be something that facilitates, USDC transfers on the back end. That's like, maybe we'll get there eventually, but that's not something that's real right now. consumer payments when I'm paying for things that are in a more business context. Like we sometimes fund investments with USDC versus a wire transfer. Like being able to send USDC is actually a lot easier if you've got an educated kind of like crypto native person on the other end. Way easier to do that than like wait the 2 days for the wire to go through. So that's one aspect I get. I don't have to do this that much, but cross-border payments is something that I think is really important and widely used. And so that's a huge use case for stablecoins. But I think the other one is, and this is maybe more in the USDS yield stuff that we can talk about, being able to look at a stablecoin as more of like a real world asset that has yield denominated or yield generated from it. And that's basically what USDS is. You've got a diversified approach of assets that are earning yield, and you can earn that yield if you stake that asset in the Sky savings rate, for instance. And so I think that there's an element of, well, let's think about the use cases. Payments, going to be hard to break into consumer and especially point of sale. I think the biggest use cases right now are cross-border for currency and then a real-world asset for yield.
What did you think then of this? So the full draft of the Haggerty Genius Act was released, I believe, yesterday. We're recording this on Thursday, and saw that it was going to be any interest payment to holders of stablecoins, or the exact word is prohibition on yield. Permitted payment stablecoin issuer may not pay interest or yield to holders of its payment stablecoins. So obviously this is beneficial to USDT and USDC, also potentially beneficial to banks if they were to issue a stable coins as well. So some people are saying it's a little bit of an incumbency or protection move here. Like, what do you guys think?
So I do agree it does benefit USDC and USDT in the US. I generally think they're like, there's a bunch of things in these bills. One is like the yield pass back. The other is like, what is the backing of the stablecoin? And I think like, Tether is not 100% treasuries. I believe Circle is probably close. Circle will probably get there. I would say that Tether probably will have like a USDT America stablecoin or like a USDT office in the US where it's like kind of like a different stablecoin that's offered specifically to US people. And basically what that means is like you're able to offer it directly to centralized US exchanges, because I think they at the end of the day will be the people who have to comply with like offering stablecoins to their users. So that's one thing. The other thing is internationally with Mika, there are different standards for stablecoin issuers, and one of which is, and there is kind of like a corollary in the U.S. legislation, and I think it's mostly on the market structure side. Is if you're a decentralized issuer, if the issuer is unknown, and you can read the Maker Sky USDS Mika legal opinion, you are effectively you're allowed more kind of creativity around what your backing is or is not. You're also allowed more creativity, frankly, to distribute yield, because if you think about Ethereum and it passing yield to its users, in the context of the Stable and Genius bill and the market structure bill, it is allowed to do so because it is decentralized. And so I think that's kind of more so how USDS and SUSDS specifically will comport with the law. But I think this legislation will effectively bifurcate a lot of things into you're passing back yield or you're not, you're decentralized or you're not. And what Michael and I were talking about yesterday when we first read some of the comments about the bill is like a lot of the C DeFi stuff is kind of challenged, because like if there's means testing for decentralization in the A16Z letter to the SEC, and I think that has a pretty strong chance of becoming something close to law, where like if you're like, talking to the centralized exchanges, trying to get your, stable coins back or your collateral back or whatever, you're not decentralized. And then you are A, an unregistered security, and B, an issuer of a centralized token in the US. So it's like, there's going to be stark lines, basically dividing these things going forward.
Just out of curiosity though, what is the link exactly between decentralization and being able to pass yield back? Like why even as a centralized issuer, shouldn't you be allowed to pass yield back? Feels like that just benefits your customers, right?
There's a stronger
Sorry.
It's what a bank does. There's a stronger argument if you are not a centralized operator, that you're basically a security, and you're just a common enterprise, and being able to pass back yield is security like.
Okay. I don't know if I like that much, but I get it. I mean, but I also think, I don't know, it would be good for you. I would like to get yield passed back to me.
Well, right. Then you have to be decentralized. It's like if you were to be a centralized operator, and everybody there's still questions on the implementation of this. Like, you get 3.9% with USDC on Coinbase right now. Is that yield passback? I don't know. You're staking your Sky and the Sky savings rate. How is that different from getting 3.9% back from Coinbase? It's not. It's the same thing. So does that count as yield passback, or is it something where the user has to take a specific action to get the yield to then, with that asset? Unclear. So there's tons of questions, but generally, if you are, it looks and feels a lot more like a money market fund, which is definitely a security, versus a stable coin, which is not a security, if everybody who owns this asset is able to earn the yield. And I think that's the argument of why
decentralized. Then, the A16Z letter and the ETH status as a commodity would imply that those rules don't necessarily apply to you if there is no control.
Right. And look, we're not policymakers, we're not lawyers.
Like a million different wait, what about this one? What about that
one? Totally.
Yeah.
And to get the yield in Ethereum staking, you have to stake your ETH. There is an action that you have to take. And I think that that's also kind of a core component to this, at least to the beans testing here, is it's not just uniform. Everybody who owns the shares of a company that issues a dividend gets to participate in the dividend, whether you like it or not. And same with a stock buyback. And there is an element of value being transported back to Ethereum in the form of a burn. So that's more akin to a stock buyback, where everybody gets to participate in that. But it's sufficiently decentralized at this point, which is the gold standard of what that decentralization means test will be. If it's not everybody who gets the yield back, and you're staking it and you're locking your tokens, you're not able to use it, then that's a totally different proposition.
I think one thing that I missed a little bit as well, just about stable coins in general and why they are very good for ecosystems, is it just the more stables that you have, it just catalyzes a lot of other activity. Guys tweet about it driving RWA issuance. I found super interesting. So maybe there's not a super easy direct way, at least in the short term, to bet, to buy something that goes up when more stable coins go up, but it should just bring more activity and opportunity and cool stuff on chain.
Look, if you're interested in stablecoins, the approach that we have taken, at least, is there's kind of two ways of getting decentralized asset exposure to stablecoins. The two ways are the rails that they run on, so either the blockchains or the L2s or the infrastructure providers for the different stablecoin ecosystems. This may be Ethereum. This could be another chain. That's going to be where a lot of the payments for stablecoin assets live. And then the other bucket that we look at is the actual issuers themselves. This could be Circle Equity, Tether Equity, if you can find it, or it could be the issuers of other decentralized assets as well.
Namada is the shielded asset hub rewarding you to protect the multi-chain. Built to give you full control over sharing your personal information, Namada brings data protection to existing assets, applications, and networks. Namada ends the era of transparency by default, enabling shielded transfers and shielded cross-chain actions to protect your data even when interacting with transparent chains. Namada also introduces a novel shielding rewards system. By holding your assets in the shielded set, you help strengthen Namada's data protection guarantees and collect NAM rewards in return. To learn more about Namada, follow the link in the description below. Hey everyone, quick shout out to today's sponsor, Marinade. Since launching in 2021, Marinade has expanded their suite of products to provide solutions for both DeFi users and TradFi, including liquid and native staking, as well as direct enterprise integrations. Marinade's platform is optimized for institutions to securely expand their exposure to Solana, whether through the provisioning of custodial or non-custodial yield, integrating staking rewards into Solana financial products, or leveraging Marinade's best-in-market rewards rate for revenue and treasury management. Whether you're in DeFi, TradFi, or somewhere in between, Marinade has something for you. To learn more about Marinade, follow the link in today's show notes. All right, fellas. I would love... actually, you know what? One more crypto story before I want to talk about VC is just Hyperliquid. So... okay, so let me try to relay the story as I understand it.
Okay.
Which is... All right, it all started with a...
way back when.
There's a little meme coin called Jelly Jelly, issued by one Sam Lesson from Slow Ventures, and a very low liquidity, like low liquidity meme coin, and I think it's like $20 million market cap around the time when this all started, and someone took out a short position on Hyperliquid to the tune of around $6 million, and then someone else began to basically manipulate the price of Jelly Jelly on other venues, pushing that price up. They forced that position into liquidation. So then it got passed on to Hyperliquid itself. And it was a toxic position. So there's also, just as like a quick overview, there's the HLP, which is this vault that kind of the value proposition of Hyperliquid in general is they list assets very quickly and they let you traders trade basically whatever they want. And so if no one wants to take that position, then this HLP vault will do that and be kind of a backstop, although there's some nuance to that as well. And so this got passed on to the protocol, and then it looked like they were looking at between a 13 and a $15 million loss. And the founder at Hyperliquid, Jeff, said the 16 different validators had convened and decided to override the price of the Oracle. They reset it. They paid out some $700,000 to traders that lost in that market because of that override, and the attacker lost all of their profit.
Just additional fun data points. There's 16 validators. 12 of them are controlled by non-team members. 4 of them are controlled by the team. Within 2 minutes, all 12 had aligned on the same perspective. That seems like a very fast conversation. Questionable at best. But so where the story continues is they decided that the Treasury was going to repay the HLP holders as opposed to giving them 12 or I think it was $12 million of losses. Instead, they decided to cover that. So they made HLP whole, and the trader had like a $700K loss. Other interesting data points are the account that made the trade was funded by Binance and OKX.
Is that confirmed that it was funded by them, or
at least that's what I saw last?
I just will say it allegedly because I don't know if that's actually the case. But I will say also, I think at least Binance listed perpetual futures for Jelly Jelly around the time of which would have driven the price up and exacerbated the loss to Hyperliquid. So
coincidence, war games, we don't know.
So look, Mark,
go ahead.
Well, okay. So to tee this all up, right? There's a lot of shenanigans here. I've seen two perspectives represented. One is that this is a centralized exchange cabal coming out and attacking the decentralized exchange. The other is, look, the mask is off here. This is not a decentralized exchange. So, if there was market manipulation and bad practices, that's illegal. We shouldn't condone that. But also, you can't team up and say, hey, this is the big centralized guy versus the decentralized guy, because this clearly isn't decentralized. No. So I'd be curious, like, where you guys fall, probably maybe somewhere in the middle on that. But
I would say it's I don't think Hyperliquid has ever said that they're decentralized. So
they call themselves a DEX.
Really? Well, that's just not true. But like, respect to the product, it's a good product. The problem with being centralized, but I guess also decentralized, is that like I guess the litmus test is maybe like KYC, and like this game of whack-a-mole you have to play. If it's like, hey, stop shorting Jelly Jelly, we're kicking you off. Okay, it's gone. Hey, stop shorting this random other. It's like you just like, at least with centralized exchanges, You got a KYC. They knew who you are. They can kick you off. If you try to get back on, they can stop you. And so I don't know. Like picking sides between like Binance and Hyperliquid, it's just kind of silly. They're all just exchanges to us at least. And one of them has a token, and frankly, like we don't own it. Maybe that changes at some point, but like as of
well,
today,
they both have tokens.
They've all got tokens. They've all got tokens.
But I don't know. Like Hyperliquid needs to change the risk model, and the other thing that I've noticed is that HLP is down from like 600 million to like 200 million. And I don't know how much of liquidity that drives on the exchange, but like I know for fucking sure when Berachain launched, they were shorting that. And so maybe it's nice that they don't have quite as much size, and that they're getting kind of pushed around a little bit more. I think that's probably good for the ecosystem, but I do think like, Binance trying to inflict more losses on not only HLP, but all the Hyperliquid users is like, I don't think we want, like Coinbase wouldn't do that. We can't have the biggest companies in our space like hunting each other. They're just like, it's a bad look in general.
Yeah. Overall bad look if that is the case. I think it's also look, it's really hard to run a perps DEX exchange. It is just as much about the infrastructure that you build and how fast it is and how you get the growth, how you get the users, as it is about the risk management. And how do you list things? How do you delist things? Like Jelly, like nobody's thought about that in probably a month, and it only was probably thought about for a week, total. Like it got listed, but then it just got left. And when you have these kind of like, orphaned markets just sitting there, like they're ripe for the taking because nobody's looking at it, nobody's paying attention. And why is it that you have the ability to go, 30% open interest based on the market cap of a single, illiquid token? Like that shouldn't be allowed. So like kind of a call to arms, I think, in terms of Hyperliquid upgrading its risk, parameters and policies. If they really do want to do this and be kind of the everything exchange, it just means that you're going to have a lot more issues like this. Can you continue to defend the HLP and make sure that they don't absorb the losses? I think they've got a massive enough treasury to be able to do that. They've got plenty of capital to do it. But at a certain point, you're like, do you hope that you're not in the HLP when the big one happens and they can't or decide not to cover the loss? Because they're also falling into a bit of moral hazard here if you end up continuing to cover these losses and that becomes the expectation.
Okay, so one thing also that's a critical piece of information for this is that the backstop here is an insurance fund, which is denominated in Hype, which is Correct. The native token. And that, to me, I don't know your guys' opinion. Well, I really don't like it.
Sorry, one data point I maybe missed or don't understand. I think it's the Treasury who's paying back HLP, not the insurance fund.
I gotta double check.
But Mike is right. The insurance fund is denominated in
Hype.
In Hype.
Yeah.
I mean, look, like a $6 million loss, like just have heard like offhand that like, Jeff's good for the money, generally speaking. Mm-hmm. And so is probably the Hyperliquid ecosystem at large. But I mean, I don't know how to quantify this, but the Hyperliquid HLP pool being a third the size maybe means that like that exchange is like a third the liquidity. Because right now, like I think people love it because you can trade these alts with size on this thing, and the HLP will kind of like take the other side. Versus like if you're trading on spot Binance, like man, like things are like thin right now. Like if you're trying to trade alts, it's like being a bull in a china shop. Like it's tough. And so I'm curious to see how that impacts it. But yeah, I would say like as the centralized exchange titans are battling, maybe just like, don't pick a side and just let it play out. These are usually like pretty short-term decisive contests where it's winner, and there's significant collateral damage as well.
Okay, so I might have been mistaken. I'm pretty sure what backstops the HLP in the event of a loss is the insurance fund, which is Hype. They might have made the decision to pay this out via the treasury, but I'll find it and look at it in the show notes. But the idea of an insurance fund being denominated in hype in general is like, we got to stop with the endogenous collateral stuff.
Cascade.
Yeah. And okay, so I don't look, market manipulation is market manipulation, and it's illegal. If there was illegal activity, then that should not be condoned. And that's just bad. We don't want people doing that. But I will say, man, it's going to be a really unpopular thing to say, but I've always been a little bit of two minds about like CZ and FTX, right? So let me draw a tenuous analogy here, and call me out if this is wrong. But the way that I looked at, when we talked about the relationship between Alameda and FTX is, remember, everyone used to think that FTX had such good tech. And it turns out when FTX failed that they didn't have great tech. There was just a hedge fund which was willing to absorb the losses of the exchange, right? So
the Scooby-Doo mask.
Right. So, I mean, it's not super different what's happening here, right? There's there's an exchange. It is of questionable decentralization. There is a backstop, right, in the form of the HLP, and there was a loss. And what CZ, look, they're not even the same quantum. That I don't want to.
The crime is taking customer funds and pulling them.
I
over
agree.
And
I completely agree. It's not nearly, there was an actual crime in the FTX. I'm just saying the construction of this mechanism, right, is potentially faulty. And what CZ did in the FTX case was he poked at a faulty mechanism. And I don't know. I mean, like could say like,
why is it a faulty mechanism? That's not where the crime existed. That's not why it blew up.
The faulty mechanism was if Alameda incurred a large enough loss, then it would actually be a problem, right? It could absorb small losses, and it was basically Sam was willing to run that trade because the equity that the cost of what he could sell the FTX equity for would more than make up for the hole and whatever he lost in Alameda, until there was a massive loss in the form of Luna, right? And that's kind of the same thing here, right? Like, okay, it's a $6 million loss today, no harm, no foul, but that is a shitty mechanism. And if there were to actually be a real attack on this, you could probably blow a massive hole in Hyperliquid. So
FTX Alameda on the negative side, and this is not the same. I'm just going to make the comparison, but maybe Citadel on the other side, where they are payment for order flow with Citadel Securities, but they also run a $30+ billion hedge fund. Like, they are trading and investing at the same time. So like there is an analogy I'd say that exists outside that works. With this model where you've got prop capital and kind of the market making capabilities, let's say, the areas that you get into an issue is where you have massive loss and can't absorb that loss. Right. That really, frankly, I think only has happened in crypto relative to the size of these firms. So maybe they're starting off on a more negative perspective, just given how wonky these markets can be. A $12 million loss, not going to move the needle, but $1 billion loss, or a hack, that would be difficult, and that would be more scary.
Also, we've done a bunch of other we've seen a lot of perps dexes come and go, and they've all had their different liquidity designs. One was the Synthetics Infinite Liquidity. Bad. That was like 5 years ago, but it was just you can't let people trade unlimited size on alts.
Yeah.
with like any sort of funding rate is not going to make you right. So that's one. Another one was the virtual AMM.
Oof.
Which remember that one?
Mm-hmm.
And I forget what they were called, but
the virtual AMMs just never caught up to the real price. And so you'd basically be able to front run or ARB or sandwich all these different VMM prices. Ugh.
And that's kind of what Hyperliquid is. But the problem with the virtual AMMs that we used to see is that they didn't have any sort of capital to correct the imbalance, nor any sort of HFT market maker to facilitate that. And Hyperliquid is kind of pioneering this via AMM model. But I think it's in my personal opinion, they did the right thing, which is saving users from any more losses. It's just one thing that we don't want. So what, they mark the jelly price favorable to them. Fuck the guy who is trying to manipulate the pricing. We should definitely be on the side of self-policing and saving users. But what will be the thing is what risk model do they come out with next, and that may even push the entire perp space forward if they can think of something that's interesting enough. So
Yeah.
I don't know. We had no bags again, but I do think it's like, I don't know. I wouldn't bet against Hyperliquid, and also like getting in a fight with Binance is terrifying. So
Yeah.
I don't even know what to think.
Yeah, I know there are a lot of like Hyperliquid's one of those coins that's done really well and people have actually made money on. Consequently, people really defend it, right? Or if they're short,
there was full-throated bag defense yesterday.
Yeah, 100%.
It's like, guys, like, I don't know. $20 was the floor, and then $12 was the floor. It's like so hard to tell where these things bottom, but that's definitely a FUD event right there. If Binance attacks you, maybe that was the bottom.
Yeah, and I'm not I think Hyperliquid's been an amazing success story, and I'm 100% rooting for it, especially if this was real illegal market manipulation. That's nothing to celebrate, right? It's kind of an interesting thought. I mean, people used to talk about this too with George Soros and when he broke the Bank of England, and there were these faulty exchange rate mechanisms, and there people just debated this, right? It was, on the one hand, it was these evil hedge funds bankrupting countries, and the hedge fund perspective was always, it was your fault for making a shitty mechanism that someone was going to exploit. So I don't know. There is also maybe an element of, this is what playing with the big boys looks like, right? Like, this is
I
mean, the highest level.
Imagine back in the day when they were fucking slicing and dicing up CLOs and shoving them into every little corner of the world that they could find, and then it all blew up, and they were like, "Oh yeah, we actually don't know how it all worked." Like, at least the transparency here is like, got it. This all happened in an afternoon, and the next day everyone's refunded, and we're trying to build something better.
Mm-hmm.
Like, it's terrifying to think about the financial experimentation that happens in big banks, where it's just like they develop a nuclear weapon and they just shove it in their fucking desk drawer, and they're like,
hopefully this doesn't go off.
Yeah. Like, what? It's crazy.
Traders, AI enthusiasts, and degens, listen up. The game is changing, and Desk is leading the charge. To celebrate their launch, Desk is running a trading campaign with 3 major highlights. 38% of their token supply will be allocated to airdrops. They're offering the lowest trading fees on Earth, and finally, they will be running a Desk referral program. The more people you invite, the bigger your rewards will be. To get started, click the link in the show notes below and make sure to follow at Trade on Desk. This episode is brought to you by Morpho. Morpho is the first and only DeFi protocol Coinbase has integrated directly into their main app, giving millions of users access to borrow against their Bitcoin on Coinbase. Just as Web 2 companies like Google, Amazon, and Meta were built on internet protocols, the largest financial companies of the future, such as Coinbase, will build on decentralized protocols like Morpho. Whether you're an individual, fund, fintech, or institution, Morpho is for you. Follow the link in today's show notes to try Morpho today.
Okay, so I saw an article in the Wall Street Journal this week, or maybe it was Bloomberg, about private equity lobbying to be able to include that in 401ks. And, you know, on the one hand, you could say, hey, like, a bunch of gains have happened in private markets, right? It doesn't make sense to exclude retail from that. The more cynical approach to that would be, private equity has run out of buyers for their bags, and they're trying to stuff it into, you know, Americans' retirements, right? Like that, retirement funds. Like, that's the, I mean, the truth is always somewhere in the middle here, right? And it depends on if they're fairly valued assets or not. But I would be curious, you know, when you guys hear stories like that.
Private equity. So, you know, historically, private equity is you're buying out a company with debt. It's anywhere from a mid-stage company to a late-stage company. You are doing whatever you can to increase revenue and cut costs. While you own that company for anywhere from 3 to 5 years. And then you sell it either to another larger private equity firm, or you take the company public. Like, that's the basic business model of private equity. And historically, you know, some of the best firms are looking at high teens to low 20s IRR. But what is incumbent within this business model is a lot of debt. And this is called the leveraged finance department at every investment bank. And it's all floating rate, and it's not fixed. So it's SOFR plus whatever, 200-300 bips. Which means that when you've got a rate cycle like we're in right now, the profitability of these business models goes way down. And when that happens, in conjunction with a very limited, if not non-existent M&A market, and a very limited, if not non-existent IPO market, these private equity firms are hurting pretty badly. You know, they can't get liquidity on assets. They're holding them longer than they wanted to. Just the interest payments alone on these assets is starting to eat into the way that they build their portfolio construction. I have a friend who works at a large fund. They had to raise a separate sidecar fund to add to their existing fund. And the entire purpose of the separate sidecar fund from existing LPs is just to pay the additional interest that they have to pay on all of their portfolio companies.
No more news like this.
So it's not good necessarily for a lot of these private equity firms. Now, the best are going to continue to do well. But it's going to be tough, I think, for the next couple of years for these firms, especially, when you've got structural change. Like, a lot of these firms were very commercial real estate focused. They were buying up buildings in San Francisco here. And I think they're still, looking at commercial real estate, but like that market has fundamentally changed, where tier 2 cities are probably more attractive versus tier 1 cities for new builds. And you've got ample, office space available in San Francisco these days. And yeah, at the same time, you've got really, really attractive opportunities on the data center build out and sort of like the warehouse and shipping container or shipping infrastructure with the Amazon and the AI effects. And so there are massive structural changes going on within a lot of these private equity industries as well. But yeah, it is bleak. I would imagine I would chalk this up to they're looking for new LP bases because it's hard for them to raise.
There was a great Matt Levine article, maybe 2 or 3 days ago, where he was writing on private equity. He said, there's one way to think about private equity is in the 80s, a bunch of guys realized that private businesses could be more levered, which is a very funny summary of basically the private
It's
equity
literally what, if anybody wants to read an amazing book, Barbarians at the Gate, it's the start. It's RGR Nabisco, KKR. Yeah. There's a terrible movie. Read the book instead. But it is, it's basically you're taking out, you're basically doing the mortgage that you do on a house, 20% down, 80% debt, and you get a lot of leverage with that. And all you got to do is cut 10 to 20% costs or increase revenue 10 to 20%. And that 10 to 20% with 5x leverage becomes 50% on that investment. Hey, look at that.
Okay, could we talk about maybe just close on M&A in crypto and just the state of venture capital writ large? There were a couple of announcements over the course of the last 2 weeks. I think we missed it last week because of DAS, but there was Kraken acquired for 1.5 billion. Ninja Traders, a futures trading platform. I think that's the largest crypto M&A piece of activity ever.
What was the size? 2.5 billion or 1.5 billion?
Like 1.5. Yeah, 1.5.
There's rumors of Coinbase getting close to closing Deribit, which is an international options exchange, which will be, that'll be fascinating to see. Do they keep it international or does that become something that's available to US customers? I think Bridge kind of was the starting gun for all of these businesses, all these companies looking at crypto and all the businesses that are doing well, but maybe not wanting to be standalone businesses that are very attractive acquisition opportunities. I think people look back on Bridge Stripe as one of the seminal kind of like YouTube, Google-esque acquisitions for the industry.
I agree. And the reason I think that's important as well is just it oxygenates the market, especially in the later stage. Dan Tapiero, one of the lead investors at Blockworks, but also 1RT and 10T funds, I saw a headline that he was predicting some more M&A or IPO activity this year, potentially in the form of SPACs. And so, if you're an equity investor in crypto and there was no token launch, you've been sitting on probably pretty overvalued at one point private equity for a very long time with very few success stories. And so I'd be curious because people have been talking about M&A in crypto for a very long time. It hasn't really materialized, but I think for the first time, it does feel like there are legitimate whispers of actual M&A activity, and 2025 being a big year for M&A. And then maybe we could just close on, just like VC in general, which has been, I was reading an article the other, it's very under stress. There's been kind of broad underperformance, maybe outside of crypto VC. What do you guys think of the M&A side of things, and then the VC industry, I guess, writ large?
M&A, I mean, I think a lot of it will actually come down to if CoreWeave does well in their IPO over the next couple of weeks. People are like, we have a path to IPO, we have a path to liquidity. Let's like beef up the business, different business lines, more of a story to tell investors. Like CoreWeave, the AI data center play, bought this thing called Weights and Biases, which is like a kind of like AI model. I don't actually know what it is. It's just like an AI model startup, just to give it a little bit more flavor. I think kind of NinjaTrader and Kraken is kind of like a similar thing where they're just trying to like beef up their product offerings and like different paths that they could, talk through on an earnings call. There are a lot of small companies that are frankly like acqui-hires. I wouldn't even consider those M&A. But I do think that given the right IPO environment, you are going to see a lot of like over $1 billion M&A into the large companies of the world. Because like as Kraken starts bidding on these assets, Coinbase is hot on their heels with other ideas, and that dynamic, generally leads to outcomes in M&A in crypto.
Yeah, fully agree. I mean, we've got a couple of portfolio companies going through the M&A process right now. It also like, just as if anybody generally wants to think about it, the way we break it down is there's sort of 3 buckets of M&A. There's people, product, and business. Those are the 3 things that they could be buying, and they kind of like increase in value over time. Buying a team, like in traditional kind of tech acqui-hires, $1 to $1.5 million per engineer is kind of like the acquisition price. And these are usually structured as like really good compensation packages at a larger company. And that's kind of like an outcome for a lot of companies that don't hit product market fit. If you do start to hit product market fit and you're buying the product, that's where there's some deeper integration. Maybe, I don't know an example, but maybe this would be like Spindle that was bought by Coinbase. Yeah. Mm-hmm. Doing an ads attribution engine. Maybe Base wants to get into more of like the ads world, and they're going to incorporate what they're building at Spindle into the Base offering. So like that's more of like you're buying the people and the product. But if you're buying the people, the product, and the business is how you get to $1 billion plus acquisition, and that's where you've got something that's attributable to the top line, maybe even the bottom line from day one. When you're talking acquisition price, it's not just the strategic value of bringing that in, like a NinjaTrader plus Kraken or a Deribit plus Coinbase, but it's also the strategic value of not having that live outside of the company and steal market share away from the company in that respect. There's a lot of ways to slice it, but yeah, I'd say. Vance, you're on mute.
Like to Michael's point, like how many people would want to buy Bridge for their company?
Well, how many people could? that's
well, yeah, it'd be like the 3rd best in that category or the 4th. Right. It's like I could name probably 5 companies off the top of my head, and especially right, but that Robinhood is going. It seems like the rest of the field is probably not far.
Yeah,
Robinhood. So that's.
I was just gonna say they had an announcement this week too about banking.
Yep.
Like they're getting into banking and they're doing a full push into crypto. Like the competition is definitely heating up in that space.
Yeah, I was gonna say Robinhood has been conspicuously quiet on this front. I would imagine that they are either working on things or thinking about things. Like they're just not sitting waiting on their hands, especially with Vlad making public statements about how excited they are about crypto. I don't even know what the acquisition capabilities are, but as HOOD price goes up, so does the opportunity set of what they can buy. Because that's the other part too, is that if you're a publicly traded company, you have your own token. It's called your publicly traded equity that you can use as a currency. But it's going to be interesting. I think maybe this dovetails into the venture perspective, but it's nice to see the M&A market starting to open up again, because historically for traditional venture, crypto venture is very different, but historically for traditional venture, that's like the vast majority of liquidity that you get. And if you're in, unless you're doing like really, really late stage, or if you're like a founders fund or maybe an Andreessen Horowitz, you're not seeing very many IPOs, even over multiple funds. And so the vast majority of your DPI, which is your distributions, comes from M&A activity. And just with, at least anecdotally, what I have heard, over the last administration, if there was any acquisition over, I think it was 90 or maybe $120 million, it got auto flagged by the Sherman Act. And so basically anything over that level had to go through the antitrust process, which basically put a stop to any M&A. Acquisitions or acqui-hires or like these, $40, $50 million acquisitions, those were still going on, but anything that really had size was getting flagged. And so the lifeblood of the venture capital industry writ large has been at a standstill for the last 4.5, 5 years. And what does that mean now? Well, we've been talking with, U.S. endowments and, there are some of our LPs, and one stat that they gave, which is pretty insane, is that they interviewed or surveyed all the venture portfolio managers at U.S. endowments, and the venture portfolio managers who range hundreds of millions to billions of dollars deployed into venture capital. They said that 70% of them over the last 5 years have been cash flow negative, which is crazy to think about, because what that means is, historically you would say, okay, the 2014 vintage venture fund, maybe it's got a bunch of things in it that go public, maybe some things that get bought in like years 5, 6, 7, 8. Those get the distributions, which then fund the 2022, the 2023, the 2024 new funds that are coming out. And so it's kind of like this, process where you're recycling capital. Well, if you have no distributions, that means there are no 2024 vintages because they don't have any money to deploy into these new funds. And that's the world that the venture capital industry is living right now. Yeah, exactly. Where there's no
like
IPOs.
The Shane Gillett meme. It's like,
precisely. Like there was some stat that I read that there's one U.S. endowment that 2% of the entire endowment is in one company. I'm guessing it's Stripe, or potential. SpaceX has enough liquidity, but like that's an insane. And think about it. These endowments, they're 10, 20, 30, 40 billion dollars, but they're only allocating 15 to 20 to 25% to venture capital. And crypto is even a smaller percentage of that venture book itself. And so if you have a $2 to $4 million venture book, and you've got, I guess at that point, 800 million of a $40 billion endowment is one company, like that is an insane proposition. Lot of risk. So I think broadly the venture capital industry is in a really, really tough place. We also heard from one of our LPs another crazy stat, which over the last 25 years, there's been 3,000 venture firms. The vast majority of them are out of business at this point. But over that 25-year period, there are on average, seven funds that those firms have had. And, every 2 years, give or take 2 to 3 years, you're raising a new fund. The number of venture firms out of the 3,000 that over that 7 fund cycle have had 3x distributed funds is 21 out of 3,000, not even 1%. So if you are, and I think venture capital, is definitely in a tough place where you have to be in the top decile. You have to be consistently delivering 3 to 5, but realistically like 5 to 10x funds. If you're not there, you're not going to stay in business. If you're median, you're basically like having to prove your worth. And if you're below median, which is basically the bottom 50%, you're out of business. And like, that's basically just how the landscape is looking. So the dispersion of the traditional venture market is happening. You've got Lightspeed, you've got General Catalyst, you've got, they're raising multi-billion-dollar funds right now. So they're obviously doing fine with their LP bases, but it just means that there aren't going to be any other firms that can get there. Within crypto, all of this is to say it's very, very different. Mostly because the liquidity profile is very, very different. Cambridge, I think it was Cambridge or maybe it was PitchBook, said that if you were in a 2017 vintage venture fund and you had any distributions, 100% of that came from crypto. So over the last 7 years, if you had any distributions from a venture fund, 100% of that came from crypto, which is why a lot of these LPs are excited about crypto right now. It's because we're not talking about 10 to 15 year hold periods for seed stage investments. We're talking about like 5 to 7 year on average hold periods. And there's liquidity in the meantime if you need to. So very different proposition, but traditional venture along with levered private equity, are both in very difficult positions right now.
Tough. Yeah. I mean, what do you attribute the challenging environment to? Is it oversupply of capital? Is it, I saw someone was tweeting about this last week, the long feedback loop that it takes. You're kind of in venture for a decade before you know you're any good at it. Companies are staying private longer. Yeah.
I think it's not whether or not these investors are good. Like, people generally know who the good investors are. It's more that these companies are choosing to stay private longer. And for the last 4.5 years, there was zero M&A activity because everything got, I mean, think about the acquisition. There's a $20 billion Figma Adobe acquisition that got shut down. The Plaid deal got shut down.
Shut down. Yeah, I forgot.
That's like, people don't understand that it isn't just like money that goes back to those investors and congrats. It's like money that goes back to the state of California, which then funds the next venture fund to go off and make the next investments. And so when you don't have that, like, the innovation economy gets hit. And that's really the big, unfortunate catalyst here, is like, it just means it's going to be that much harder, which means there's going to be less venture dollars, which means people aren't going to be able to raise. And so it all trickles down.
Do you think that Figma, I forgot that Figma didn't go through to Adobe. Was that a Lena Khan era decision?
Correct. Yep. Same with the Plaid one.
So, man, do you think that Figma just caught such an unbelievably raw deal at the same time that ChatGPT is making everything Studio Ghiblified, and it's easier than it's ever been, right? To be a graphic, you have to imagine that feels existential to them.
Totally. So hard to tell. Like, I think Figma could be bigger because of AI, or it could be a zero.
It won't be a zero. I mean, they're like multiple billions of revenue.
Right.
I don't know. There's so much, especially in Web 2 right now. It feels like there's more platform risk than ever in traditional technology. Like, oh, sorry, your job / company has been deleted because now we can. I saw someone make like an old school Blockworks ad. It's fucking sick. Like, that would take literally 24 hours.
Dude, Yano did that. He showed me the prompt. I mean, it took 15 seconds. That wasn't a crazy prompt. That was like,
I mean, here's what I will say. Just like getting back to the whole like venture, stuff discussion. Like, if the CoreWeave IPO does well, the capital markets will turn back on. There will be more M&A. There will be more IPOs. Like, and I think, like, my guess is that someone from the Trump administration is on the horn to like the big banks, being like, hey, so this is obviously an important IPO, but like, if the perception in the US is that the IPO window is actually closed, like, I think the Trump administration is not doing their job. Like, there's a lot of vested interest for this to go well. But I mean, the oversupply of capital is not the problem with venture. It's like guns don't kill people, like people kill people. Like, there was people behind those dollars making poor investment decisions, and they were mostly boomers. And I think there was just like this 10-year period from 2005 to 2018 where it was just like, oh, you're like a reasonably smart dude in tech. Like, you probably have amazing deal flow. Just like, please disabuse yourself of that notion.
I do think the reason why it has taken effect is historically the venture industry as an asset class was like a rounding error on the private equity asset class. And now they are, frankly, like, look at the breakdowns of any of these U.S. endowments. And U.S. endowments I would consider them to be like some of the most sophisticated asset allocators, especially the Ivy Leagues. And they break out venture capital from private equity now, whereas that didn't used to be the case. And they look at them as distinct asset classes because they're big enough. And when you used to have like the benchmark, and even go back and look at the fund sizes of like the 90s Kleiner and Sequoia funds, those are like 3, 4, 500 million max. And there's this concept in venture, which is an interesting one. It's like, where do you incentivize? Are you incentivized by the 2 or are you incentivized by the 20? And what that means is, are you an asset gatherer or are you an asset multiplier? And if you have a smaller fund, you obviously care more about the multiple because you want the 20% carried interest of the performance that you make. Whereas if you're raising $4 billion, you get paid $80 million a year for 10 years off of that one fund. Isn't that great? It is a crazy math equation when you really break it down. And some of the GPs at those firms are like, well, I could really fight my butt off to be able to get like a 3x fund, or I can just kind of like ride this out at like a 2x fund and get paid $10 million a year for the next 20 years. Like, it sounds easier to go option 2. So there is the effect of the denominator effect has taken over, and without distributions, these endowments are sitting on massive gains, which just means they can't allocate to new firms and new funds. So that it furthers the problem, but it is what it is now.
Hey guys, who would you guess is the new cover of Forbes magazine?
Justin Sun.
Yeah, His Excellency.
Dude.
Yeah.
My only question on seeing that, I saw that right before we hopped on. My only question is, how much did that cost?
I mean, I didn't even look like him on the cover. I thought that was like entirely AI generated, but devastated to hear it's real. Forbes, what are you doing?
The president's $8.5 billion crypto savior, Justin Sun.
Do you know what Trump hates? Being spoken for, or being told that, you bailed him out, or like all that shit. Any goodwill he engendered, he just deleted.
Yeah. Crypto's billionaire Barker.
Like, have you ever seen Steve Witkoff or like any of the cabinet speak about Trump or anything they're doing? It's always like, Trump enabled this, so we did it. Trump made the decision. Thanks to Trump, we did that. None of it is like, we bailed Trump out. He made the wrong decision. Like, Trump's gonna fucking freak out when he sees this, is my guess.
I agree with that. I don't think he's gonna appreciate the bailout comment at all.
Nope.
Yeah, I don't think that. I don't
think
that.
People monitor crypto Twitter. I've had people from his team reach out to me on CT and different stuff. Like, let's see.
Yeah. I don't actually think you can buy Forbes covers. I could be woefully naive and wrong about that. I would be, if you can, then you.
Well, you're not directly paying for it. You are paying an expensive PR firm to do expensive things that then get you in front of the people.
When am I going to be on the cover of Blockworks, bro? You should make a physical magazine.
Oh my God. I think there are actually a couple of crypto. Doesn't Bitcoin Magazine have a physical?
Yeah.
It does. Vitalik used to write for it.
Yeah. Wow. You know what? So Pete Rizzo just recently joined Blockworks, the host of Supply Shock, and he was mentioning, I think he was actually there for / hired Vitalik that's a crazy statement to make in general. But yeah, he used to write for Bitcoin Mag, so they've been around for a long time. Props to them. All right, fellas, I think we can call it here. This was a fun one.
Yeah.
See you guys next week.
Later.